All right, so let's talk about this. So we're talking about equity partnerships in general, but I think this is going to discuss sort of real estate investing for regular folks, folks like me, and how people can get into this even if you're not necessarily savvy in these things. So first, we should talk about sort of, who am I? Like, why should you listen to me? So how did I get into this? What happened to me? So my name is Dan Grove. It's on the screen, but and my contact information is there, right there. I am a pulmonary and critical care physician. So I'm a doctor. I work in the intensive care unit. I'm an ICU doctor. I also do lung diseases. I live in Baltimore, Maryland. So just as a warning, no pun intended, we have a tornado warning. So hopefully the Wi-Fi will hold. I was part of a pretty successful private practice. I was a junior partner. The practice was the largest in the Mid-Atlantic region in our specialty. And we had an office, we had thousands of patients, and then we had a contract to work in the intensive care unit. So the hospitals signed a contract with us that we are the primary providers of critical care at these hospitals. And so we had a lot of control over sort of how we, practice medicine. We had a lot of control over how we set up the our practice, how we set up the office, who we hired, and everything we did was tailored towards the patients, what's best for taking care of our patients, because that was our whole focus. We were doing very well, and then right in the middle of the pandemic, so everybody had a different experience of the pandemic. For me, as an ICU doctor, I was like right smack dab in the middle of it. I was in the ICUs. And so we're in the middle of the Delta wave, which in Baltimore was the busiest time of year when we were overflowing. We were all working like crazy, seeing more patients than we'd ever seen, really overworked. They sent us an email. The big hospital system that controls the hospital sent us an email that said, you have to join us, or you have to join us and be our employees. Otherwise, you can't work in our hospital anymore. And they canceled our contract. And we were stuck. Like there was nothing we could do, right? We had no leverage. We had no bargaining power. So we had to dissolve the practice. And then we all ended up working for the hospital system. There's multiple hospital systems, and we kind of split up, and people worked for whichever hospital system controlled the hospital they worked at. And sort of overnight, went from somebody who was part of a practice where we were entirely patient focused, where we had a complete control over the way we delivered healthcare, to becoming like a cog in this big corporate like bureaucracy, this big corporate machine. And and I think maybe a lot of people have worked in that kind of environment, and it was hard for us because we went from being in control to now. And if we wanted to do something for our patients, if we wanted to change something, we had to go through 5-6 layers, it seemed like, of middle management. And most of these middle managers they weren't doctors, they weren't nurses, they weren't even, PAs. They were people with masters in business and masters in health administration who had no clue about what we were dealing with. They didn't understand the practice of medicine other than what you learn in a classroom about, I don't know what they learn in the business schools about this stuff. And so it became very difficult. So I was in this situation where I found myself completely at a loss of control and at the mercy of a system which didn't necessarily have my best interest at heart. So I wanted to take back control. So I started looking into other avenues of investment, right? I got a home equity loan, right? I took out, I started reading. I had some savings, and I got into, just general real estate investing. I started buying houses with that money. And then I learned about creative finance. I started joining a community with somebody named Pace Morby. Some people have heard of him if you've ever been on YouTube looking at videos. If you ever search like real estate investing on YouTube, you'll find probably at some point videos of him, and learned about creative finance and how to acquire houses in different ways. And so I wanted to do this because I wanted to take back control. I wanted to have an avenue of income where if the hospital says you need to see more patients, you need to cut back your hours, we're cutting your salary, I didn't have to live in this constant fear of that happening. And so this is my avenue. So I started then my next step. Now I've transitioned to the next phase, and I'm developing systems to connect with wholesalers, people who find deals and get the best creative finance deals, and then connect those and find people who want to invest in those deals, and then partner with the people who want to invest. Okay. So my mission then is to partner with individuals who are sort of tired of low returns and the bank fees, corporate investment firms, because they want to invest in something, tangible, right? They want to have, maybe you have money to invest. There's a lot of people out there who there's monies in a money market account, in a CD, under their mattress, and maybe they're in a mutual fund and they're getting robbed by the fees, right? And they want to maybe try something else. Maybe there's some people who have all their money in the mutual funds. They like to have a diversification, right? Like we see, like the stock market can drop at any time. The real estate market tends to be a little more stable, right? And even if the real estate market fluctuates, one house is typically pretty stable, right? The rent pretty much stays the same. Even when in 2008, even when the housing market crashed, values crashed, but rents stayed the same. They actually went up. So if you had a house that you were renting out, you were okay. But there's also some people who really always wanted to get into real estate investment. They have some money saved, but they don't know where to start. They don't know what to do. They would, maybe they're nervous and they want to partner with somebody who's had some experience and either work together and gain the experience or just let someone else do all the work. There's lots of reasons that people would want to join in this. So just first, just in general, why should anybody invest in real estate, right? There's numerous advantages, right? There's numerous advantages, short-term, long-term, and there's a reason why most wealthy people have real estate investments, right? And even back to Teddy Roosevelt, right? He says, everybody who invests in well-selected real estate in a growing section of a prosperous community adopts the surest and safest method of becoming independent. Real estate is the basis of wealth, right? And so, it's 401k saving, retirement saving is very important, and that it helps you provide income in retirement, but those are not, you can't build wealth through retirement savings. The advantages of real estate are multiple. So you get leverage. So leverage means I can use a small investment to control a larger asset. So for example, if I want to buy $100,000 of Apple stock, I have to give Apple $100,000 or whoever I'm buying the stock from. If I want to own $100,000 worth of real estate, I can spend $20,000 and then get a mortgage. And the reason I can do that is because real estate is a tangible asset that is much more reliable, as collateral. So banks are willing to do that. And because the government wants people to have housing, so they back these 30-year mortgages. So you can leverage, you get tax benefits, right? It's a whole separate discussion, all the ways you save money on taxes with real estate investing. I mean, the reason that really sort of wealthy real estate developers don't pay a lot of income taxes is because of these benefits. Now, they pay a lot of taxes. It's just not income taxes. Most of their money goes into property taxes that they pay on each of their properties, but they don't pay income taxes because there's a lot of benefits. You get more steady cash flow. So rental income is typically more predictable than other investments. It's really hard to predict dividend income from stock investments. You get appreciation. So this is really nice, is that if you're willing to stay in real estate investments, they're one of the safest investments there is because, everyone needs a place to live. And if you look at the housing market in the United States, since they've been keeping data and you just select any 10-year window, right? The housing market has never dropped in any 10-year window. So it may have dropped in a 3-year window or a 5-year window, but it always comes back by 10 years. So for example, if you bought a house in 2007, right, at the peak, and then by 2011, you had lost most of your value. But by 2017, you were ahead, you were up again. Okay. So you can lose money in the short term in value, but it's pretty safe bet that eventually it will rebound. I mean, that's it's a simple supply and demand issue, is that there's only so much land and there's only so much places that people will be able to live, right? That's close to work, that's close to what they want to, be close to. So that's always going to create a limit on supply. And when there's always a limit on supply, then there's going to be an increase in value, in price. So you get control, right? If I don't like my iPhone and I want to improve my Apple investment, I can't call Cupertino, California, and say, hey, listen, can you make this change so we can improve the value of our stocks, right? But if I'm an equity partner, if I own half of a house or all of a house, right, like I can make a change. Like I can decide we're going to add a bathroom. I can decide we're going to fix this. I can decide we're going to raise the rent. Like I have control over sort of the asset and what it does, and which is a nice thing for many people. You get the advantage of loan pay down. Loan pay down means that every month there's debt on that property, but every month the tenants who are renting are paying down the mortgage. So the house is increasing in value with you doing nothing. The tenants are essentially paying off your debt, right? Isn't it great if you can have a situation where someone else pays off your debt, right? I think this may be the only situation. Real estate can be generational. It's much easier. It can pass down. It can continue to there's ways that you can turn real estate investments into things which are sort of tax deferred, and then you can put them in trusts, and you can create something called infinite banking and family office. There's a lot of things that you can do as a means of passing wealth and creating generational wealth. And finally, diversification. So we talked about this before, that you can it's a great way, if you have all your money in one investments, to diversify. So now, if you ever hear, so again, like, why real estate? So I had somebody try to convince me to buy or to look into this new fancy investment vehicle that's something I'm not going to be able to explain to you because I didn't understand it. Something related to a life insurance, and it was guaranteed not to lose. And it was this amazing, and there was a YouTube video, and there was this guy who was talking really fast. And so, I was like, it was just perfect. Like nothing could go wrong. Right. So obviously, like, first of all, I don't invest in anything I don't understand. Right. And second is, like, there's very few things that are like that. And the question that you have to ask is, if whatever investment is, investment X, if investment X is so awesome, why isn't everybody doing it? Well, you could apply that to real estate. So everybody's investing in real estate. Like everybody who has money has real estate, right? So it must be that it's that good, right? Like there's a reason why the King of England is so rich, and it's not because of his social media following, right? He doesn't take a nice salary from the British government. It's because the royal family are huge landowners, right? The Vatican is very wealthy, not because, like, the Pope doesn't make a lot of money, right? He took a vow of poverty. The reason the Vatican's wealthy is because they have vast land ownings, right? So real estate is what wealthy people do to stay wealthy, right? And so that's been done. Andrew Carnegie knew it. It's something that's just everybody knows. Okay, so now that's why real estate, right? That's why I got into real estate. That's why I got excited about it. That's why I'm trying to build a future based on it, right? I'm not going to quit. I don't want to quit my job as a doctor. I love being a doctor, but I want to be able to have that flexibility and then have something that I can maybe create for generational wealth that can go to my, God willing, great grandchildren, right? But what is creative finance? So why creative finance? What does that mean? What are we talking about? So there is a great sort of myth. I think it's a bit of a scam. I don't know if it's a conspiracy. There's this myth that many people have, which they think that the only way to buy a house is to get a realtor and a mortgage from a bank. Okay. And people think that if you don't do it that way, that's the traditional way, then it's illegal or you're not allowed to. People think that the only way that's legal to buy a house is that way. Okay. And I think it's probably perpetuated by the banks and the realtors that's true, right? I mean, the people that are most vociferously against buying a house any other way than the traditional way are the realtors, right? But this being a free country, right? God bless America. You can buy a house anywhere in any number of ways. You can, like, Brian, I could sell you my house. I could write on a beer napkin and I could say, like, I will sell my house to Brian Swinton, and he's going to pay me this amount of money every month for this number of years. And we could take that napkin. I could go to the county assessor's office, and they might have us transfer it to a piece of paper, right? But but I could technically do that. And people have been doing that for as long as there has been property ownership, people have found creative ways to sell their property. Okay. Now, somewhere between sort of dirty beer napkins and the big banks, right, is a large area of opportunity. And so there's multiple ways to buy houses, and these things are called. I'm just going to list these. Like, this is not a discussion about like how to do creative finance. Maybe we can do that another time. But this is just a list of the sum of ways you can do seller finance. There's something called subject to deals, hybrids, lease options, novations, and there's other things you can do also. And that's why it's called creative, right? Because they offer the ability to be creative in how you structure a deal that it benefits more people, right? So why do I prefer creative finance? So there's a lot of reasons. One, it's usually a lower initial capital requirement. So if I go through a bank, I usually have to, the bank will mandate a 20%, down payment, which could be a huge amount of money. Whereas if I do it in another way, maybe a seller will do it for a lower down payment, right? A seller can sell me their house. They decide they want a 4% down payment, right? And that's fine. Like, we can work that out. There's more flexibility, right? So for example, there's a lot of houses that you can't sell on the traditional way because it doesn't work, right? You have faster closing times. Like, I don't know if you've ever bought a house and the banks do this like financial colonoscopy where they want to know, every place you've ever lived in your whole life. Like, I remember for my house, like having to remember like the address of my college apartment my senior year, and every loan I've ever had, and listing all these things. And it was so many documents, and it took weeks just to get the approval. And that takes a long time. That can delay things, which is a problem. Like when somebody's trying to sell their house and you delay it, that's hard for the seller, right? You get more opportunities for what I call a win-win-win situation, right? So this is a situation where sellers, buyers, investors, we can all win in a situation. So I'll give you an example. There's a house I acquired in Florida. So here's the story. There's a lady who moved to Florida to get medical treatments because there was a hospital, like specific treatments that she needed. And in the process, she bought a house, and her plan was that her daughter was going to take over the house, rent the house, right, when she was done with her treatments, and she was going to go home. She finished her treatments. She had huge medical debts, and her daughter couldn't rent the house. So now she couldn't afford the house, and she was behind. So she was, I mean, literally, like, when we closed on the house, I brought her house up. She was going to be foreclosed on the following week, right? And so she was going to lose the house, right? The house wouldn't sell. There was not enough of a profit or equity in the house to pay off the arrears, to pay for the agent commissions and all that stuff. So she was unable to sell the house. So she was heading down a road where she was going to be foreclosed on. Her credit was going to be destroyed, and she would have to deal with the stress of all that. The banks weren't even going to win because it's expensive for them to foreclose on. And so there's no option for her with a traditional realtor. And that's what they all told her. Well, we did something called the subject to transaction, which is she transferred the deed to me, and I took ownership of the house, and then I'm paying her mortgage. We've been doing it for a year and a half now. And I brought her house current, so she was no longer behind, which means that her credit got fixed. We fixed her credit. She didn't get foreclosed on. I was able to even give her a little bit of money to help with moving expenses. She was overjoyed that she got out of this terrible situation. And I acquired a house that will be able to be a good investment for me. And everybody wins. And that's how creative finance can really impact lives in a lot of positive ways, right? And there's a lot of stories like that. And the last is you get lower transaction costs. When listen, the banks are wealthy enough, right? Every time you do anything with a bank, they are adding fees. They call it points, right? There's points on the loan. They make it sound like you're scoring. Like, hey, I got a bunch of points, right? It's semantics. That's a fee. It's a percentage fee, and they call it points to mess with your head. So every time you get a bank mortgage, right? Every time you get a mortgage, you're going to end up paying money to the banks. Well, if you don't use the traditional banks, you can create structured deals where the banks aren't getting what they're getting. You know what I mean? And so it's a win in that situation. Okay. So if you ever want to, we can do this again. I want to have a discussion specifically about other stories and cases of how creative finance can work. I'm happy to get on a call and discuss it with you. Another way to, so that's with purchasing, but I always wanted to bring up something called private money lending. So private money lending is a way that many people will invest in real estate in a passive way, a semi-passive way. So private individuals can lend on real estate deals, right? Why should the banks have all the fun, right? So somebody can lend me money and have a house be collateral, which is essentially a mortgage. That's what a mortgage is. It's a loan where a house or real estate is collateral. And usually lenders can get, these private money lenders can get between 8 to 15%, depending on, the terms they negotiate. So that's better returns, right? Like I usually use the benchmark of if you had an S&P 500 index fund, which usually people get when you adjust for inflation, for fees and stuff like that, be like 8%, 8 to 10% annually. So you can usually get a better annual percentage rate on this. So it's a lot of times it's a better investment, but there's some issues. Like you have to do a lot of work vetting the deal, right? So you have to make sure the buyer's not a crook and that, he's not cheating you. And then you also have to make sure that the house is a good deal, right? Because it could be a good buyer, but it's a bad deal. And then you lend your money and they can't make the payments. And then your money is making nothing and it's stuck. I know a lot of people who've gotten stuck in these deals. You have to know a lot about real estate too. Like you want to be able to, you don't want to lend on a deal that's not going to make money. And so you have to kind of know if a deal is going to make money because the people borrowing are always going to tell you it's going to make money. Okay, so that's private money lending. And with private money lending, you really don't get that full annual percentage rate because PML loans are usually 3 to 6 months and there's usually a gap, right? So there's a gap between loans where you're not making anything. So for example, let's say you search for a month and you find a loan. You have money in the bank, you find a loan where you can loan somebody money and they'll give you 12% interest, which in this case would be 1% a month, right? And they give it to you for 3 months. So you make 1% a month for 3 months. So you just made 3% on your money and then they pay you back. So now you have your money back. And then 3 months later, you spend 2 months. Now you spend 2 months finding another deal, right? And during those 2 months, you're making 0%, right? Now you vet the deals, you vet the buyers, you find another loan, which is a 6-month loan at 12%. So you get 6 months of 1% per month. So actually you had 9 months in that year where you were making 1% a month. So your actual APR is about 9%, not much better than an index fund. And you took twice the risk, right? Every time you redeploy the money, it's a new risk. So some people can do longer term PMLs, which is lower risk and less work. And they usually have lower rates, but if you're going to be a PML, you should definitely do long term because you definitely will make a higher overall rate and you have less risk. Okay. So finally, there's something called being a private money partner, which in my opinion is a better choice. And the reason is because true wealth building comes from equity. So now what is equity, right? So it's possible to give money. So instead of lending money like a private money lender, right, you can actually, you can give your money to the deal, which is more like investing in the deal. And then instead of getting a monthly interest rate as a payment, you get a percentage of the profits that come in every month from the rent, and you get equity. And equity is where the magic happens. Okay. So equity essentially is the amount of money you would get if you sold the house, right? So if I sold my house now, whatever I can make in profit, after commissions, remember there's the realtors again, right? Right. Is what the equity is. So equity increases when the market increases. Equity can increase with renovations, like if you improve the property, that's called forced equity. And also equity increases when the debt gets paid down, right? So the value goes up and the debt comes down. That spread is called the equities. That's why when your tenants are paying down that mortgage every month, you're building equity. Okay. So for example, probably a lot of you know what equity is, but just in case, essentially, if you have a house you sell it for 300 and you owe 250, then your equity is not actually 50. It's 50 minus the sales costs, commissions and stuff like that, usually 8 to 10%. Or if you buy a house for 200,000 and you upgrade it, now it's worth 300,000. Okay. But you spent $70,000 in the upgrade. So you spent $270,000. Now your equity is 30,000 minus the commissions again. Now, here's where it gets fun. Okay. You can actually estimate what the equity on a property will be based on an estimated appreciation rate. And the way you do that is something called a future value equation. Now, a future value equation is the equation for calculating compound interest. Okay. So, but by the way, you don't have to know any of this math. Just Google it. Google future value calculator, you can figure it out. Okay. So, but just in simple terms, right? If I have a house that's worth $100 and it appreciates by 10%, that means over that year, I'll have gained $10 and the house will now be worth $110. Now the next year it increases 10%, but it's not 10% of 100, it's 10% of 110, right? And so now it goes by another $11, right? So now it's worth 121. And then the same thing, and so on and so on. So this is how compound interest builds exponentially. Okay. So I can do the same thing. So I can figure these out because there's a math equation that will tell you, you plug in the starting value, you plug in the appreciation rate, and then you can calculate what the house will be worth in a certain period of time. So I typically use, and by the way, this is the calculator. You would just plug in the number of periods is the number of years you're going to estimate for, how many starting amount, and then the interest rate. You usually want to leave this as 0. You don't want to add money, but I told you the same case of starting with 100 and having 10% interest at 10 years, you would have $259.37. So a profit of $159. And you can do that with any value, any time, any rate. I typically use a 4% estimate. And the reason I use 4% is because that's been the national average of appreciation since they've been keeping records. 3.84%, around that. Some places it's more, some places it's less, but that's an average, okay? The other way you can do it, the other thing that you do, so you start with a future value, I can estimate appreciation, but I want to know what's the balance. Because remember, my equity is how much I can sell it for minus how much I owe on it. So I need to estimate or figure out, you don't have to estimate, you know exactly how much will I owe on that mortgage in that period of time, okay? So a way to figure that out is using an amortization table. Now, amortization is one of the greatest scams the banks have ever sort of put on us, right? What amortization means is that when you have your interest rate, right, and you say I'm paying a 6% rate on a $100,000 loan, the bank could figure out how much interest you're going to pay over 30 years. But instead of dividing that up equally over 30 years, they front load the interest and they backload the principal. And so that way your mortgage payment's the same every month, but the amount of money of that payment that's going to interest is higher in the beginning and lower in the end. And so just look like at this chart. So like at year 10, you can see the green is the interest. At year 10, you would have paid about half of the interest because the interest is about 210. You can see it's about 105. So you've paid half of your interest in 10 years. And you've only paid down about 25% or so of the balance of the principal. Okay. This way, the banks, if you sell your house before like 15, 20 years, the banks are guaranteed to get their money. And that's why a lot of people are surprised when they've owned their house for 5 years, they've been paying their mortgage every month, right? And they find that their balance is not that much lower than when they started, right? They've been paying every month and their loan balance is like the same. And that's because of amortization. And so I don't know why that's legal, but it is. If you can, write your congressman to get them to get rid of that, but it is what it is. But because of this, you can figure out, in 10 years, what's the balance on this loan going to be? If I know what the starting balance was, if I know the year it started, if I know the interest rate, I can figure out from these tables exactly what it'll be at a certain time. So then I just do a simple subtraction. So I use my future value calculator and I say, what's this house going to be worth in 10 years? Go to my amortization table. I say, what's the debt going to be? And that difference is the equity. So I can estimate what the equity is going to be in 10 years. And that can give me an idea of a conservative estimate on my return on investment. It's as good as you're going to get. I mean, you could do the same thing with the stock market. It's not perfect because, nobody can actually predict the future, but it's as good as you can get with any investment because any investment, you can't predict the future. Okay, so let's do a couple real life case studies. I'm actually going longer than I said I was going to go, but there's a couple of case studies to give an example. The first one is a deal I've done, and the second one is one I just got under contract. So this is a house in North Collington in Baltimore. This house, I bought this as a subject to, so my investment was about $50,000. It rents for $2,500 a month. My total monthly payment, including management, is $2,108, right? So the profit is $319. Okay. That's a cash on cash return. A cash on cash return means that of my investment every year, I'm making 7.7% from the cash flow, which is not spectacular, right? You'd be like, I might as well just put my money in the index fund. And if you were only getting the cash flow, that would be the right thing to do. But if you look at if you plug in these numbers, so what I did was if I calculate the future value at 4% in 10 years, I did a 10-year. I always do 10 years because of what I told you before, that the housing market's never fallen in a 10-year window. So I'm using a 10-year hold. It could be longer. You might do shorter. Like if the house appreciates very well, some markets, they go crazy. You might want to come shorter. But if I assume 4% appreciation at 10 years, it'll be worth 466, 276. The balance I've got from the amortization table will be 207,590. And the difference is about $260,000. I will have add another $40,000, which is the rental income. And that was, by the way, assuming I never increase the rent, which usually you do increase the rent over a 10-year period, the rent will go up, which means that my total profit is going to be $302,000. Okay. Now, and that's a 600% return. So now if I would have put that $50,000 in an S&P index fund at 8%, I would have made I would have made a profit. So it would have been $157,000, a profit of $107,000, which means by taking that $50,000 and investing in an index fund, if I would have done that instead of this house, would have cost me almost $200,000, right? And this right here, the equity, this is the magic. This is the wealth building. This is how people really become successful with real estate investing. It's really hard to get rich quick in real estate, but if you can wait, like you can get rich slow, right? Patience is rewarded, right? And in a lot of things. And you can see, so now, and this number, like, okay, so this helps me, like, hey, what if I have a bad year and I can't rent it for $6? Well, like, that takes 10,000 off this, but it's not so bad. Like you're really covered with patience because of the equity. Okay. Now this is a house I just got under contract. This is a 5-bedroom, 2-bathroom house in Denver. It's soon to be a 6-bedroom, 2-bath, and maybe a 7-bedroom, 3-bath. Depends on, I have a contractor going there hopefully tomorrow. The investment for this one, I would call it $90,000. I'll probably make it $90,000 just because you always want to have a little cushion. So this house is going to be a co-living house, which is probably the future of affordable housing in America. Just I can do 30 seconds on co-living. In co-living, individuals will rent a room in the house instead of the whole house. Now, why would they do that? Well, there's a lot of reasons. One is that in some of these cities like Denver, where the rental prices and the housing prices have gone up so fast, most people are priced out of even the rental market. So if you have a single guy who has a good job, maybe he can afford $900 a month in rent, but he can't afford $1,800, right? And so he can rent a room in a house, and then he can then afford it and not be on the streets, right? There's also some of these houses become very fancy, and there's young nomads like I guess Gen Z, I don't know what, I was Gen X. I don't know why they started with X. It wasn't raised, but it started with A. So I don't know what the generation is now, where they call them digital nomads, right? These are people who they graduate college and they don't want to commit to anything. They don't want to commit to a lease. They don't want to commit to a city. They don't want to commit to a job. So they'll sort of rent rooms in these actually like Airbnb level houses. And then they don't have to deal with a roommate. They don't have to deal with a lease. They can just live there as long as they want, and then they can leave. So this is the future, because, many politicians in the government are trying to do everything they can to lower the cost of housing, except for build more housing or make it easier to build more housing, because the problem is a supply problem, and you can't fix a supply problem with policy. You have to fix a supply problem with supply, right? So this is a solution to the supply problem, because now I'm creating supply without having to build more houses. Like now I'm housing 6 people in one house instead of having to find 6 apartments, 6 1-bedroom or studio apartments. So it helps solve this problem. And because of that, you get a higher rent. So it's good for the tenants. It's good for the landlord. So this will get $800 a room. So up to, if it's a 6-bedroom, $4,800 a month. Expenses are higher. You have to pay utilities and stuff like that. But still, profit's about $338 after I include money saved for maintenance, repairs, vacancies, and stuff like that. I might say if I get a 7-bedroom, that's going to be $1,100. So Fingers crossed on that. Okay. So that's not a great return, right? And you might think like, why would I invest in this house? The cash flow is terrible. So the cash flow isn't great, but when you plug in the numbers like we did before, the future value will be close to $1 million. I use 6% appreciation because this is in Denver. It's 15 minutes from downtown, and it's 10 blocks from a neighborhood that's gentrifying. And the gentrification is moving in the direction of the house. And it's a nice neighborhood. So I use a little bit of higher estimate. It could be higher, you know. It would be worth $961,000. The loan balance in 10 years will be $386,000. So that's an equity of $574, right? And then a profit of $631,000. So that's a profit that would be split 50-50 with the equity partner. So if you would have put 90,000 in an S&P index fund 8%, you'd make $185,000 profit. Okay. Which means that the net loss would be half of that, $436,160. So you're losing hundreds of thousands of dollars by putting your money in an index fund and not putting it in an equity partnership. Okay. And this is much better than you would get with a private money lender. This is much better than you can get in just about anything else. Okay, so now when people partner with me, if somebody's an equity partner with me, they're a full and equal partner, which means they get 50% of cash flow. We have to put money away for savings, but then they get 50% of equity at the sale. They get tax benefits on 50% of the equity. They get equal decision making, right? They can have as much involvement as they want. Like if they want to have no involvement, fine, I'll do everything. If they want to be involved, they can be involved. And they can also access my connections that I've made over the last 2 years. If they want to then go off on their own, right? If they want to get the experience, get the knowledge, and then do it themselves, they can do that, right? And they can use my connections, and they can access the experience I've gained from my successes and failures. And I think so then, you know, I'm taking care of all this stuff, and then they can have access to an investment that would be just about any other investment that the regular people have access to. So this is just an example. If you want to know like how it works, we do the steps, the due diligence, we sign the contract, and that's already been done with this house. But this is how we do it. Then we have people double check the property. We have a handyman, contractors make sure it's okay. We can get inspections if necessary. Then we set up an LLC. The LLC is 123 Main Street LLC, and that LLC will be 50% owned by my LLC, and then the investor or their LLC. And then we set up a bank account. The bank account will have a checking with that house LLC. The bank account will have a checking and a savings. Every month, the property manager will bring in money from the rent. They will take off their management fees. They'll dump it in the checking account. The checking account will then transfer money to the savings account, which we will use in case we need to fix a roof, an HVAC, or whatever, or in case there's a period of a vacancy. And then every quarter or every year, whatever the person wants, we will then divide up the rest and distribute it. Okay. The person who's investing doesn't give their money to me. Don't trust me. Don't give me your money. What you would do is you would give your money to a closing attorney, a title agency, and they would make sure that the money is distributed fairly, and they'll keep it in escrow to make sure that everybody's protected. And then we'll set up property management, we'll do everything else. And that's basically, these are some other prior deals. You can ask me about these later. I've talked too much, so I don't want to keep anybody, right? If you can ask me about these later, other deals we've done. And then this is sort of what we do. So we want you to be involved as much as what. So I'm going to stop there. And I'm going to open the chat. I don't know if anybody has questions. If anybody has questions, you can put in the chat. Otherwise, I will take your logging off as a sign there's no questions. But you can also, if you want to drop your email in the chat, I can send you more information. I'm going to also put in my chat you can see on this last page, I'll put my contact information. So you can send an email, or you can call me. Okay. Yeah. So Brian asked, is there a servicing company? Yes. A servicing company is very important. So what a servicing company will do is that so for example, this house in Denver is subject to, it's a hybrid. So I'm taking over the person's mortgage payments, and there's a equity, $140,000 in equity that she's then gonna let me pay her monthly. She's letting me pay her at 0% interest. Okay. So now that's a lot to coordinate, and I don't want to have to deal with any of that. So there's a company that will pay, like you pay them like $10 a month, right? And what they'll do is they will automatically withdraw from that bank account that we talked about, right? The combined account money. They will then take that money and they will give some of it the amount they have to pay the underlying mortgage, and then they will give the rest to that seller finance note. And that is that's beautiful, because then I don't have to deal with it, and then nobody can claim that that they didn't get paid, right? Because there is a third party document. And also that allows that for somebody, if the person who does a subject to, and this is sort of beyond the scope, they can maintain their DTI. If anybody knows what it is, you can ask me about it later. So that's an awesome question. So Sarah asked, is there a minimum investment to gain entry? There is not a minimum investment per se, because every house is different, right? So the minimum investment depends on the entry fee. So every house is a different entry fee. And the entry fee is made up by a number of things. One is some money goes to the seller, often, not always, but sometimes they want as like a down payment. There's usually commissions or fees to the people who bring the deals. There's closing costs. There is money for repairs. There is sometimes you have to pay off arrears, and then there's holding costs, which means you plan on paying the mortgage every month until it gets filled by renters. And so that number is what the investment is usually. And so that depends on the house. So I've seen as low as 30. I've seen, usually they're between 50 and 100,000. That's what I've been seeing, but I've seen lower and I've seen higher. It depends on the house, right? Every house is sort of different. Okay. Robin, great question. Is there a possibility to set up a self-directed IRA to fund these opportunities? Absolutely. And actually, that's a great way to do this. So if anybody doesn't know what a self-directed IRA is if you have a money in an IRA, and if you can email me and I'll tell you the company that I've used. If you have money in an IRA, right, then you can take that, and instead of it being, I don't know what, in like Robinhood, I'll use Robinhood since it's Robin. If you have Robinhood, or if you have, I don't know, like Vanguard or whatever, you can take that money, and there's companies that will be a custodian for you, and they will take that money and put it into an account with an LLC separate. And then you can take that money and invest in whatever you want. You can buy real estate, you can buy baseball cards, it doesn't matter. As long as you don't benefit from the thing, right? So you can take that IRA, and then you could invest in one of these houses, right? And then instead of every month the profit going to you personally, because that would trigger a penalty IRS, it would just get dumped back into that IRA account, and then you would make money. And then when the house sells, the money goes back into the IRA account, and you would definitely make better. So that's a great use of an IRA, because then you get longer returns on money that you don't really need now anyways. And so I think it's a great thing to do with a self-directed IRA. So Brian asks, how many people can invest in an opportunity? So that is, there's no limit on that. So if somebody wants to say, like, okay, so somebody wants to say, I want to combine with someone else to come up with that entry fee, and then split the 50%. So that it would be like each person would get 25% of the equity in the deal, and they would split the cost. What you would then do is the ownership of the house LLC, the ownership of 123 Main Street LLC would be delineated in the operating agreement, that who owns what percentage. Okay. So that then you can, and then that's how you would work it out, divide things up. And so, yeah, so multiple people can invest in one house if they want to get into something, but they don't quite have enough, or they want to partner with someone else. Okay, so I think that's all the questions. Are there any other questions? Okay, so I'm gonna stop sharing, and if anybody has any questions, you're welcome to ask. And I will stay on for another 15 minutes, every 10 or 15 minutes. 10, I can stay on for another 10 minutes. Then if everybody else can log off, or if you want to stay on and ask a question, it's fine.
Hey, Dan, it's Brian. Just wanted to say this is a really amazing presentation, and I appreciate you taking the time to do this, man.
No problem. Hey, Robin, one question, if you're still on. That email is vs.com, I'm guessing. lorgvs.com. Oh, another thing I can do right here is, I'll do like this. Let me do this. Let me get on real quick. I'm gonna put in a link to my Calendly. This is my Calendly link. So if you want to set up a meeting, we can meet separately. Oh, Teresa asks, what exit strategy will the house have? So this house will be a co-living. So it's going to be rent by the room. Now, the good thing about this house is that if there's a problem with the co-living, it breaks even as a regular traditional rental, right? So that would be like an emergency. Like, I don't know if the city just says, oh, we're shutting all these down, which they would be stupid to do because then they'd have a huge homeless problem, right? But then we have a backup plan. Like I always like to have with these houses 2 options, right? So that if it's, if it works as a regular traditional rental, that's fine. But if it works for something else like Airbnb or midterm rentals, which we do, co-living, I also wanted to make sure that it also works as a long-term rental, regular rental, just in case there's a problem. Okay. Cool. Let's see. So it looks like there's no more questions. So,
Oh,
here's one. Yeah. So this house right now, I have put it out to some investors, but I'm definitely would definitely take a partner on this house in Denver. You can sign up on the Calendly. I actually have some slots tomorrow, I think, if you're interested. I have somebody that is a maybe, but if you're interested, I could put you on the backward, like you could be like on deck, I guess you'd say, or if she, or we could talk about it. There's another deal I have coming in Baltimore that is a potential deal, so hopefully that will, come through. I should find out over the next few days. That's going to need. It's going to be. I'm actually on that one. I'm waiting to hear from a co-living manager to see if that one also works as a co-living. In which case, it would be an amazing deal. If it works, if it's not a co-living, it still is a good deal, but it would go from good to amazing in co-living. Yeah. So I haven't gotten under contract yet because like I always go to experts to determine my underwriting. So I won't just go and guess, or I won't just use the online calculator. I'll ask property managers. So for this one, I'm asking a property manager that actually in Baltimore connects with different nonprofit groups to help people get housing, like battered women, transitional housing for people and stuff like that. And so I'm waiting. I got to call for her, call her back tomorrow to see what she would think about this house. If not, it still works as a regular rental. So yeah, sign up, Teresa. Sign up for the Calendly. We'll chat. The house is in Baltimore City, so everything in Baltimore City is about 20 to 30 minutes. It set me up for 30. It's about everything in Baltimore City is 20 to 30 minutes from BWI. So
this is so cool.
yeah, that's why I got so excited about this. Like, they're like, why is a doctor doing this? I'm like, well, this is cool.
Was this something that was percolating prior to the, like, I guess what was the incentive? Were you always kind of interested in real estate as you were being a doctor, or how did that work?
No, not always. But what happened for me, this is interesting. So this is like, you want to talk about regret. Regret's a great muscle, right? So in 2009, I lived in Atlanta. I was finishing my medical training in 2010, actually, 2010. And I had a friend who was a successful business person. He had started buying real estate because in 2010 in Atlanta, you could buy a house for $35,000. And so he's like, you got to do this. I was like, I don't have any money. So what he did was he like fronted the money and then had the bank refinance it because But at the time, I knew nothing about any of this, right? And so I got these two houses, and they were being managed, but not like expertly. And so there was always problems, like which I thought at the time were like catastrophic, but now that I know are like normal things, like the tenants made a mess, and I had to constantly, you got to constantly put in money for this and money for that, and I didn't know about putting aside money for maintenance and repairs. And so and I was like finishing my training, and I was moving out of Atlanta. I didn't want to, and so it was like overwhelming. So I just sold them. Now I like made money on them, but when I recently look at houses in the area in Atlanta that these houses were in, these houses would have appreciated $400,000 each. I mean, they would be worth $400,000-$500,000 now in those neighborhoods, and I bought them for $35,000-$40,000. You know what I mean? And then so then from that moment on, like I've been like kicking myself, right? You know what I mean? I found out, it's like, oh. And then I learned, and then but so this time when I got into it, this time I learned from that mistake. I learned from my mistakes. I was like, this time before I do anything, I'm like major deep diving all of this. And I read the books and all, like one of the nice things about going through the medical training is that you learn to sort of consume large quantities of information, in short periods of time. And so I really did my homework this time. So this time I've been prepared, and even being prepared, you're not prepared, but I'm expecting it all now. And so then in the process, like making the mistakes, I've learned a ton over this process that has that sort of shaped how I am moving forward. And it's made a huge difference. Okay. So I asked, what do we do if we want to do zero work, but invest? That's fine. I'll do all the work. That's no problem. Some people want that. Like some people want to invest and just say, you take it, and then I'll just watch the value go up or whatever, I didn't say this, but the investor will have access to the bank accounts, but also the property management software. So you can see that the rent's coming in, and you can check in stuff. And then you can periodically, if you want, although, every couple of years, you can go on Zillow and find houses that sold that are similar in the neighborhood. You can see what it's worth. So what are the terms of what? Of the Brian?
The investment.
Okay. Yeah, so the terms are the investment is to cover the entry fee, and then everything's split 50-50, 100%, like everything's 50-50. And so yeah, 50, you get 50% of equity, 50% of cash flow, and you can take 50% of tax benefits if it works. You check with your accountant. And so that's the agreement. You'll be protected with your name on this LLC, right? Which then has its name on the deed. So you'll own half the house recorded. Plus we would do a joint venture agreement, a legal document that will delineate sort of, who's does what, right? So like Sarah says, if somebody wants to just do nothing, it'll say in the document that, Dan Grove will make all the decisions, or it'll say Dan Grove and, Brian Swinton will make decisions together. And then it'll say, okay, this is how, and then, this is how we get out of the deal. This is what happens if there's a problem. This is who's doing what and stuff like that. You can work that out in these JV agreements.
Hypothetical situation.
Hey, what?
Let's say a husband and wife decide to invest, family funds into one of these situations. Then they hit a roadblock. And they want their money, they want to split everything, liquidate their investment. How would that be handled through the JV agreement? Like how
so that's what you put in the JV agreement. Like, hey, what happens in the case of divorce? What happens if somebody needs to sell? And so what we'd have to do is like you'd have to what you would do is you would usually what would happen is it would trigger an appraisal. And then the appraisal would determine the value, and then you get refinanced. Then you get a cash out refinance that would pay off, and then half of that goes to the unhappy couple, which may be less than their, it depends. Like it may be less than their initial investment. If it's like after a year, right? It might be that, or, another option is we could, step one would be to try to find a replacement investor. You can sometimes do that, right? Where they, essentially then you do an appraisal, and then the investor comes in and takes over that 50% stake, whatever, you know, whatever 50% of the equity is at that time. So there's, yeah, that all needs to be delineated in the agreement, right? So I know they say fences make good neighbors, but I think good contracts make good neighbors.
Makes sense.
Okay, well, I'm going to sign off now. So on this, you see my contact info, you know, anyone can reach out. I'm going to post a recording. So if you know anybody that that may be interested in something like this, you can pass on my contact info, and I'm happy to get on a chat with them and then send them the recording. Okay, you guys have a great night. If
Thanks,
you're in,
Dan.
watch out for tornadoes.
Take care.
Okay, good night, guys.
Good night.